Warm welcome to another week ahead video, guys. This week's video will cover the trading week running from Monday the 6th of September to Friday the 10th, 2021. And even though we have a very busy schedule in the form of central bank events, we think between the BOC, the ECB and the RBA will by far be the most important one between the three of them. So that is where our focus will be. Now, when we look at the Aussie dollar, the Aussie has seen quite a fall from grace this year with a fundamental outlook which has been dented by a couple of factors. Firstly, the ongoing virus complications in the country. Secondly, a slowdown in China's economy, as well as commodity prices like iron ore taking quite a beating lately. Now, a few weeks ago, these factors were enough for us to move our previously weak bullish bias for the Aussie to neutral until we got a little bit more clarity on these three factors, these important drivers for the Aussie dollar. Now, from the 20th of August, it does seem like the currency has been able to carve out a bottom and has been one of the best performers, second just to the Kiwi dollar, of course, in the past 2 weeks. However, the majority of the upside we've seen in the currency hasn't really been due to an overall improving outlook for the economy. I think that's important to keep in mind. It has, of course, been largely driven by very overstretched net short positioning in the Aussie dollar, which meant that the odds of seeing some mean reversion squeezes to the upside was really increasing week by week. According to the CFTC non-commercial positioning, the Aussie went from a total net long of about 3,000 back in May to a total net short smaller than 60,000 with the most recent COT data updated until the 31st of August. So by using a simple Z-score, that build up that we saw in net short positioning was over a 3 and a 2 standard deviation move on just a 1 year and a 6 month look back. So that, of course, in isolation doesn't mean that an asset like the Aussie dollar can't continue to grind lower, but it was enough for us over the last couple of weeks to really stress that there was a higher probability to see some mean reversion playing out at some stage. Now, the rip that we've seen higher from the 20th of August has been massive. If you take a look at the year-to-date low, we came in very close to that 71 cents level, and that steep run to the upside was enough to see the Aussie dollar, for example, on the back of a weaker dollar as well, to basically recover about 40% of that total year-to-date high to year-to-date low drop with about a 370 pip move in a very, very short space of time, just about 11 trading days. So it's been a real big rip to the upside. And again, even though there has been a few positive catalysts in the mix, like a weaker dollar, overall positive risk sentiment, as well as that better than expected Q2 GDP data we got for Australia, the move higher, in our opinion, has been typical behavior of a market that had gotten a little bit too stretched and needed to see some overdue unwinding to the upside. Now, that brings us to the week ahead, where we, of course, have that RBA meeting coming up. Now, recall that the RBA surprised at their August meeting that took place on the 3rd of August when they decided to keep their planned September tapering in place despite the escalation in the virus situation at the time. Now, what's interesting, though, when we got the minutes of the meeting released afterwards, we saw some minor downside playing out for the Aussie dollar again, because it revealed that the bank, despite having an overall optimistic outlook during their meeting, they actually did consider possibly delaying that tapering. And why is this important for us? Well, it's important because of this chart on the screen. This chart shows us the monumental climb that we've seen in virus cases compared to the most recent data that we've seen, and obviously compared to where we were during the August meeting. Now, that should provide all the context we need for this incoming meeting, because if the bank was possibly considering delaying their September tapering back in, on the 3rd of August when cases were this low, then surely right now it's probably going to be a done deal for them to do that. So with this in mind, the current market consensus going into this week's meeting, majority view among participants, is that the bank will announce a delay of their previously planned September tapering, which would have taken tapering from the current 5 billion Aussie dollars per week to down to about 4 billion Aussie dollars per week. Now, the obvious opportunity then for us is if the bank decides to surprise markets again by actually sticking once again to their planned tapering, which will show that the bank, not only has a lot of confidence in the overall economic outlook, but also that the virus challenges they're facing right now will be mostly transitory and not enough to really change policy. So given the fact that positioning could have still some room left to run, to unwind, this could create quite a push higher in the Aussie dollar and something to watch. Now, the other end is also true. The bank could also surprise in the other direction if they choose to, not not only delay their planned tapering, which is consensus right now, but if they also announce an unexpected increase in their current asset purchases. Remember, current purchases is running in the pace of 5 billion per week. So if they push that up to 6 billion, that will be a massive surprise for the markets. Now, again, this isn't consensus view right now. Consensus is for them to basically just hold that planned tapering of 1 billion. But given that the recent rip higher, should have seen at least some of that stretch positioning unwind. Now, if we do see them taking a more dovish tilt and basically increasing asset purchases, that will drastically once again increase that current monetary policy divergence between the RBA and the likes of the RBANZ, the BOC, the BOE, the Fed, and that could open up some downside opportunities for the Aussie dollar as well. So in that event, we'll need to keep a very close eye on those key technical levels in the Aussie pairs, and positioning, of course, as a sizable drop lower in the Aussie could see further unwinds in positioning as well. So just do keep that in mind going into the week ahead. Now, in terms of hawkish and dovish outcomes, then it's going to be fairly simple for this meeting, guys. In terms of the hawkish outcomes, we'll be looking for the RBA to stick to that planned September tapering. Remember, consensus right now expects a delay. If they say that the virus hit to the growth outlook as well as the economy, if they downplay that and they say that, listen, the hit is going to be mostly transitory, that is also expected to be more positive for the Aussie dollar. And if we see them coming out saying that the recent escalation in the virus, if this hasn't been enough for them to basically change their rate path projections, still sticking to a first possible hike for 2024, that should also be seen as more hawkish. In terms of the dovish outcomes, if we see them not only announcing a delay in tapering, but actually increasing that quantitative easing to 6 billion, that'll be a negative for the Aussie dollar, negative for Aussie 10-year yields. If they say that the virus hit to growth in the economy is much larger than they previously anticipated or thought, that is also expected to be more of a dovish tilt. And if they say that the rate path projections have now been potentially pushed back to 2025, possibly even later, that'll be seen as a real dovish tilt. Now, in the event of a hawkish outcome, we would look for some opportunities in Aussie Kiwi to the upside and Aussie ZAR to the upside. In terms of dovish outcomes, we would look for Euro Aussie upside and Pound Aussie upside. Now, why Aussie Kiwi and Aussie ZAR in the event of a hawkish tilt? Now, when it comes to the Aussie Kiwi, despite the squeeze higher that we've seen in the Aussie recently, Aussie Kiwi has remained very close to its recent lows as the fundamental outlook for the RBANZ and the policy divergence continues to grow between them. However, the pair is on key technical support, and even though the Kiwi is expected to grind higher in the weeks ahead, a clear bullish catalyst that creates less of a policy divergence gap between the RBA and the RBANZ could see a sizable move higher in terms of the Aussie Kiwi. So that is something that we're watching in the event of a hawkish tilt. In terms of the Aussie ZAR, this one's a little bit more interesting. The recent appreciation of the South African rand or the ZAR has caught our eye. It seems a little bit at odds right now with the country's economic prospects. We've got unemployment right now, the highest in the world. We've got unexpected to climb higher. We've got growth that is slightly better than forecast, that's true, but also expected to slow. And more importantly, the terms of trade aspect, which has really been a key driver for South African rand upside, is expected to take quite a hit with its key exports. If you take a look at South Africa's key exports, which is platinum, gold, iron ore, we've seen all of them tumble in recent weeks, pushing to the downside, while its main import, which is of course oil, has remained fairly close to recent highs. So that is a real negative impact, and expected to see the terms of trade really take a real beating in the weeks and months ahead. So that is a negative input for the South African rand. Now, when it comes to Australia, iron ore is of course also Australia's biggest export, but in terms of its terms of trade, it has held up better compared to South Africa, because its second largest export, which is of course coal, that's the one here in yellow, that has continued to actually rise as oil, despite iron ore prices that has fell recently. Now, it hasn't been enough to also stop a big hit to Australia's terms of trade. That hit is expected in terms of trade, but the hit is expected to be far less compared to that of South Africa. Now, the other angle why we like the ZAR versus the Aussie here, once again, coming back to iron ore, is let's say we see a further drop in iron ore prices. That is expected to hurt South Africa's terms of trade a lot more compared to Australia's. Even though iron ore is a bigger export in Australia, it's more important to South Africa right now because it doesn't have such a big component of coal as an export to make up for the drop in iron ore. So it should hurt SA a little bit more compared to the Aussie. And in the event that iron ore starts to move back up to the upside, again, that is expected to be more of a positive for Australia given the size of exports compared to that of South Africa. Now, the biggest risk to further upside for the South African rand from here is if we see much faster, more aggressive hikes from the SARB, from the South African Reserve Bank, or if we start to see massive tumbles coming out in coal prices alongside iron ore. That's expected once again to hit something like Australia a lot more compared to something like South Africa. So in the event of a hawkish surprise, we like Aussie ZAR upside as well as Aussie Kiwi upside. In terms of the dovish outcome, why we like Euro Aussie upside and Pound Aussie upside. If we take a look at Pound Aussie, it should be obvious why we like this one to the upside, because we do maintain a bullish bias, of course, on sterling in the medium term, and we've seen quite a push lower recently over the last couple of weeks as we've seen that positioning in the Aussie dollar being unwound. So if we do see an overly dovish tilt coming up from the bank, upside in Pound Aussie could be attractive. In terms of Euro Aussie, this isn't really driven mainly by fundamentals because we do still maintain a weak bearish bias on the euro. But given that the Euro Aussie pair has continued to drop and euro positioning is also stretched to the downside right now, we would favor some short-term mean reversion upside in Euro Aussie in the event of a very big dovish tilt coming out from the RBA. All right, guys, so that's everything from our side for the week ahead. We hope you guys will have a fantastic week ahead. As always, any questions, don't hesitate to let us know.